Thank you for joining Canberra Apartments webinar. My name is Chris Tao. Joining with me today is the sponsorship team, Jim Biggs, Nicole Neal, Brian Neal, and our KPs, Shankar and Jack. The sponsorship team really liked this particular property because through our business research and investigation, CBRE already provided an appraisal report valuing this property at $10.5 million as an after repair value in 24 months. As we go into the webinar, we'll share the details of that information. Location, location, location is the 3 golden rules of real estate. And that's exactly the right description for Canberra Apartments. If you follow us on Facebook, you'll see that we have provided numerous posts talking about there are 6 Starbucks within a 1.5 mile radius of the property. And also further on, you'll learn from this webinar that not only the Starbucks is around the property, but there's a lot of regentrification, a lot of migration into the property near Canberra. CoStar report also show that the median household income within 1 mile radius of the property is $42,000, 3 miles is $46,000, and 5 miles is around $50,000. And then also on the same CoStar report, expected population growth from 2019 to 2024 is about 9.2%, where the national average is around 7%. So there's a tremendous amount of migration into the immediate centers around Canberra, which leads us into the business plan. Through our investigation and research, we projected that our average cash on cash return on this property will be between 8.5 to 9%, giving our passive investor about 95 to 100% average return over 5 years. Not only this has been validated by the property management company, but we have significant local comparisons that supports the market analysis that we have done. Okay. We have to show you this slide because our lawyers told us so. So obviously, I'm not going to read every single word of that. Please read through it. Take a moment, read through it. At the end of the webinar, we will share everything with you, and they will have the full disclosure within it. But generally, what this thing is talking about is that all investments are at risk. Any numbers that you've seen so far is in the projected return. The sponsorship team in no way are guaranteeing the numbers you're seeing. So please do your own due diligence. Okay. Overall, we're going to talk about why we're here, some of the one-pager that you'll see in terms of if you don't want to sit through it, if you don't want to listen to all the information, the executive summary will give you everything you need to know and how to invest at the end of the slides. We'll quickly go over, Brian and Nicole will go over the market analysis. Jim will talk about the property overview and the CBRE appraised value, sales comp and rent comparables, and then back to me talking about the financial analysis, and finally finish out how you can subscribe to the investment. Okay. Canberra is a 64-unit property in Phoenix, Arizona. It's built in 1971 and has already been fully rehabbed in 2016. As of December of 2019, occupancy is 93.8%. Location, again, 6 Starbucks around 1.5 mile radius. And then within 1 mile radius, there's a Costco as well. So tremendous amount of regentrification, a lot of great demographics. Our sponsorship by no means are expert in predicting the market. However, having Costco and Starbucks being there already, it really solidified our approach to this property. And then, as we talked about, CoStar report already projected a 9.2% population growth just around the property itself. Why Phoenix? Why is a Texas cowboy investing property, and also along with a native from Chicago looking at property in Phoenix, Arizona, simply because it's lower cost operation in Phoenix, Arizona. Property tax for this one is only $29,000 a year, and we're projecting to be 5% year-over-year growth compared to Texas, where the tax bases are calculated at the purchase price. So significantly amount of cost savings just from buying a property in Phoenix, Arizona, and enjoy a $29,000 tax versus $300,000 tax, property tax. The key to the success is a stellar sponsorship team. Together with our KPs, we have over 2,500 doors and then almost 500 doors locally to Phoenix, Arizona. And definitely partner with the best in the industry. The property management company we have selected, it's native to Phoenix, Arizona and headquartered there. They have combined 40 years experience between the CEO and the CFO, and they currently own and manages over 75,000 units. Simply put, your investment, we're asking minimum $50,000. We're going to give, there's only limited slots for $50,000, and we're going to give higher preference to investors who are investing $75,000 or more. In return, we're keeping this a very low cost offering, 80-20 split all the way across. We're guaranteeing 8% pref. That means, we're estimated to provide 8% pref. That means our investors will get 8% before the sponsorship team makes a penny from the deal. And we will have a clause as we get into it, talk about catch up and so on and so forth. We're looking to raise $2.6 million, and expected return or anticipated return is 18 to 21%, with an average annual return of 18 to 21 because we're looking to cash out refi in year 3. Okay. Talking about the sponsorship team, Nicole and Brian, they are local to Phoenix, Arizona. Brian, matter of fact, only lives 5 minutes from the property. Together, they are part of the founder of Desert Palm Investment Group. Together, they have 717 doors here across 3 states. Out of the 717, 110 is here in Tucson, Arizona. Okay. Jim is the founding partner of Jeroma Enterprises, comes to the team with tremendous amount of experience in real estate, currently have a lot of doors under his belt as well. Myself, I'm the lead sponsor and the asset manager for Urbana Apartments in San Antonio, Texas. The reason that I'm on this team is because I've already have a first-hand experience with chiller system, where Canberra is also a chiller system. So I bring that level of experience into the team and help the team manage through some of the chiller experience. Our key principals are Jack, a duo, and Shankar Krishna. Jack, many of you might recognize him. Most recently, he just closed a 236 unit property in Phoenix, Arizona called Flats at 2030. Flats is only 6 miles from Canberra. So again, Jack's bring a lot of hands-on experience working in the Phoenix submarket. And over his 10 years of being in real estate, he has over 800 doors. Shankar, he is the COO and 51% owner of Idea On, multi-million-dollar IT services based out of Silicon Valley. He brings a lot of the structure, execution, and best practice for the team. So with that, I'll turn to Nicole and Brian for market analysis.
All right, thanks, Chris. Wanted to thank everyone again for being here tonight and expressing interest in Canberra Apartments. The whole team is excited to jump in and share with you more about the overall market and this amazing property and opportunity. All right, so without further delay, let's jump in and take a closer look at the Phoenix market. So Arizona continues to be ranked among the top markets for job growth. In fact, the latest U.S. Bureau of Labor report listed Phoenix as number 2 in the United States, citing nearly 85,000 jobs added between December 2018 and December 2019, nearly doubling the national average. With a population of nearly 4.6 million and about 200 people moving to the greater Phoenix metro per day, job growth is projected to remain strong through 2020. Banner Health, Walmart stores, City of Phoenix, and Arizona State University are among the largest employers in the state, all with locations near and around Canberra Apartments. All right, so this slide illustrates market trends of apartments between 10 to 99 units from the first quarter of 2018 to the first quarter of 2019. According to ABI, average price per unit rose significantly, increasing a staggering 23%. Occupancy rates remain high, consistently over 95%, and average rent growth was up 8.4%, continuing to be one of the highest in the country. Okay, taking a look into the submarket, in the words of Harold Samuel, location, location, location. It's one of the primary reasons we're so excited about this property. According to CoStar, within a 1-mile radius of Canberra Apartments, population growth is projected to increase a staggering 9% to nearly 30,000 people by 2024. Median household income is over $42,000, while median home value is on the rise, sitting at over $237,000. Canberra is surrounded by substantial economic growth, laying in the path of progress along the border of the prominent neighborhood of Arcadia. Arcadia has become one of the most sought-after places to live in the valley, known for its nice parks, high-end shopping, and hip restaurant scene. Looking ahead, CBRE has named Phoenix as a top 4 multifamily performer in 2020. In addition, the City of Phoenix has plans for a major expansion to the Metro Rail, approved through 2026. The expansion will continue to allow an increased number of Phoenix residents ease of commute to many top employers and entertainment venues across the valley. In summary, the Arizona economy is on pace to post another year of strong economic growth, with the Phoenix Metro producing a majority of Arizona's overall growth. Job growth in Arizona is booming. According to Governor Doug Ducey, Arizona is projected to add 165,000 jobs over the next 2 years, supporting solid increases in wages, incomes, and taxable sales. These are all great indicators that make Phoenix a strong market for multifamily investing. All right, so now I'm going to go ahead and pass it over to Jim to give you an overview of the property.
Thanks, Brian and Nicole. So Canberra is a 64-unit apartment community that was built in 1971. It had extensive interior upgrades in 2016 that included new cabinets, granite countertops, vinyl flooring, and black appliances. The building has pitched roofs, masonry construction, and an existing boiler chiller system for the HVAC. Roughly half of all our parking spaces are covered. You can see from these photos that many of the existing upgrades will allow us to attract a tenant that is befitting the 6 Starbucks located in walking distance of the property. We also have some of the trendiest and hot new restaurants and coffee shops all within a 3-mile radius. Our amenities will include a pool, a large meeting and picnic area with barbecue grills and sun sails. Also a dog park and on-site management that will include 24-hour maintenance. The unit mix at Canberra is 20 studio apartments, 20 1-bedroom, 1-bath, and 24 2-bedroom, 2-bath units. The average unit size is just under 600 square feet, and we are purchasing at 20 to 25% below market rents and below the average price per door in our submarket. This is a value add play that relies primarily on 2 factors. First, This is a management play, and we will be instituting RUBS out of the gate, plus beginning a re-tenanting process. To address that, we interviewed many professional property managers in Phoenix and narrowed our choice to 3 that we felt could execute our business plan. And we felt it was important that our choice had executed a re-tenant and major CapEx plan recently. Property management has worked closely with us to develop this business plan. Second is CapEx. The major issue is the HVAC, which is the biggest item on our rehab budget and will be addressed beginning day 1. By executing on these 2 items, we should stabilize the property in 12 to 18 months. Also, I want to point out that our property management firm is not only one of the largest in the area, they have a 4-state footprint, but also have been in the market for many years. We purchased an appraisal early on in the process to verify our underwriting and business plan. We had one of the largest appraisal companies in the industry, CBRE, confirm our pro forma ARV at $10.5 million. This solidified 2 facts for us. First, this is a heavy value add and will require roughly 12 to 18 months to implement our business plan. And second, that we are getting a great deal. Furthermore, it will give us the opportunity to refi and pull out a large portion of equity as soon as we stabilize the property. We are projecting a capital event that will return roughly 50% of initial investment to our limited partners while continuing to pay a preferred return of 8% to investors forward till the disposition of the property. And this pro forma is based on a refi in year 2 or 3 and a 5-year hold. This illustrates where Canberra lands on the price per door of our nearby competitors, which are all within walking distance of the target property. You can see that the range is anywhere from 113 all the way to 200 per door, with the average being 154 per door. And as stated, we are purchasing at 117 a door before rehab, or roughly 125 a door after rehab. This puts us well below market price after rehab and presents us great upside potential. Here, the rent comps tell the same story. We are roughly 20 to 25% below market rents, and I will remind everyone that our projections for rent growth are 1/2 or less than the industry projected rent growth for the Phoenix MSA. The Metro has been one of the leaders in rent growth in the country for the past several years. And according to Greg Willett, chief economist at RealPage, Phoenix developers have not been able to keep pace with demand, and supply is well below projected needs for several years. Even better news for us, Phoenix rents are $230 below national norm. And with that, I'll toss it to you, Chris.
Thank you, Jim. So we're going to go a lot of exciting information you heard from the sponsorship team, Brian, Nicole, and Jim. We are very excited about the opportunity, and we have solidified a lot of our business plan based on the in-depth research that we have done. So as mentioned, Jim touched on this a little bit. Our primary business plan is focusing on the management. During our due diligence, we discovered that the chiller system is only 75% operational. The heating, domestic heating, does not even work. So the management, whether it's under the instruction by the seller or the seller did not get the proper information from the property management company, but you can imagine the quality of the tenant that were willing to live on a property that has granite countertops, new cabinetry, vinyl flooring, and tile throughout in the wet areas, but without proper heating and cooling. So right in the very beginning, what we want to do is recognize the lack of keeping up the pace, whether it's a seller's issues or a management issue. As mentioned before, we are looking for the best of the best within the Phoenix Property Management Company. We have 3 choices. We're finalizing as we speak that can execute the business plan. to provide the best return for our investor. Again, fixing the deferred maintenance. As you've seen some of the pictures, the exterior wise, you have the actual property name start to peel off. If you are familiar with the Phoenix market, you'll see that every property within walking distance from ours are putting in fresh paint, increasing the curb appeal, while our Canberra property is basically the ugly duckling within the area. So it does not really, when you visit the property today, you really don't feel that there's people enjoying a cup of coffee from Starbucks living on the property. You really feels like these are the tenant base that cannot afford a cup of coffee. So we wanted to increase the curb appeal, bring the tenants back into market rent, and obviously with the people that don't mind living on lower conditions, the management team has not been really strong about charging late fees and charging pay parking, so on and so forth. So we are looking to bring other income aligned with the market as well. Okay, how are we going to spend about $800,000? Primarily, it's going to be in the AC area. We're looking at a potential of converting chiller system into individual AC, spending majority of our capital expense budget there, and then followed by fixing the heating, and rest of it will focus on the curb appeal and so forth. As you've seen in the previous pictures, there's not much to do in the interior. However, we want to be mindful of keeping up with market trend and our competitors. It's a very common thing in Phoenix, Arizona to everybody put in white cabinetries and quartz instead of granite countertops, and definitely stainless steel. We're not focusing on that, but we certainly do have some budget set aside if we need to implement some of those interior upgrades, but not all. As mentioned, the purchase price is about $5.7 million. We already confirmed and received a term sheet that will give us 75% leverage, including the rehab. We're looking for a loan amount of 6.2, and we're putting in capex of about 800,000, working capital 145, and then closing costs of 280. That will give us a total price of $8.7 million, and we're looking to raise about $2.4 million from there.
Just a quick correction, Chris. The purchase price was 7.5.
Thank you. What are we offering? This is a 506C. It's only available to accredited investor only. We are projecting IRR of 18 to 21% with a 5-year average return of 95 to 100%. All of our passive investors will enjoy an 8% preferred return. Again, that means our passive investors will get their 8% return or a catch up even before the sponsorship team make any money. Looking to raise about 2.4 to 2.6 in a complete 80 to 20 split. As mentioned before, we're looking for a minimum of $50,000 investment. However, those slots are very limited, and we're expecting this to go very quickly because the preferred return in our projection. So we will give any investor with $75,000 or higher a priority. And if you have done business with any of our sponsorship team, including KP partners, you will be given priority on those as well. So in terms of year over year, in terms of cash flow and the percent of return, we're not, because the heavy value add that we're performing, we're not expecting to be able to pay out in year one until we fully execute our business plan and be able to stabilize on the property as quickly as possible. By year two, we will project to produce 9.67% distribution. In year three, 8.9% will come from the rental income, with a total of 52.3% return to our investor. So tremendous, almost, we're projecting at least 50% or even higher in year 3 to return about half of your equity. Year 4, 8.4% out of the cash flow, and plan to exit at year 5 with about a 9.2% from the rental income and rest of it from the proceeds at exit. What does that mean? That means 9.05% cash on cash during the time the property is stabilized between year 2 through 5. You will get about approximately 2x multiple, equity multiple, and a 18 to 21% IRR. As mentioned before in the very beginning of the webinar, we're keeping this very lean. We're not taking any acquisition fee or disposition fee. We're taking a standard 2% asset management fee based upon the effective growth income, and then a refinance fee of 1%. The refinance fee is when we actually either refi at a year 3. And everything will be split between 80% to our investors and 20% to the sponsor. Overall timeline, the most important things is February the 6th. That's where we are today. Shortly after our webinar, we should be able to start taking funds as early as February the 7th. Keep in mind that you have to review and sign the PPM before you can submit your funds. But in the following slides, we'll show you how to reserve your seats even before you're signing your PPM. Okay, we're looking to close our funding by the 28th, approximately 3 weeks after our webinar, and then looking to close by March 9th. Okay. If you're interested, this is the instructions you need to follow to secure your spot in this investment. Immediately send an email out to canberraphx@gmail.com with the comments on the subject line. Provide how much you want to invest and the type of investment you want to do, whether it's cash or IRA. Please let us know if you're looking for other forms of investment, and we will do our best to try to accommodate. If you are married, please make sure that you include your spouse's name and email address, because each of you guys will need to sign the PPM document as well. We're trying to run everything through DocuSign. We're trying to save trees and not have to print out and ask our investor to print out, run to FedEx and scan and fax back to us. So we will do everything through DocuSign. Let us know if you need a refresh course on DocuSign, and we certainly will walk you through and handheld you through the process. Because this is a 506C, all of our investors need to be accredited investors. We will send you, after you send us the email, we will include a accreditation certification that will need to be signed by someone that's licensed. Typically, we'd like to appoint that person as a CPA. If you have someone else that can sign that, let us know, and we want to make sure that we get the right process and paperwork for you. Okay. Once you complete all the documentations, then we will provide you with the wiring instructions. This is a very important point. In the past, especially on a very attractive offering like this, a lot of things move very, very fast. So as much as we want to reserve a seat for you, if there is a tiebreaker, it's whoever wire in the money that breaks the tie. So we will do our best to hold the seat for you, but we have to meet our timeline in order to close on time. So please do not hesitate. Don't wait on the money. Let us know if you have any special circumstances, but without a doubt, wire in the money, first come, first serve. Okay.
That will conclude our presentation for tonight, and we will finish up by answering any questions. Okay, it seems we have a few questions coming in. Okay, what is a preferred return? Well, the simplest explanation is the investors have a higher equity position than the deal sponsors. So whenever there's profits to distribute, the preferred investor gets paid first before deal sponsors, meaning that the deal sponsors take no profits until the pref has been paid. And also, not all deals offer a pref. And even when it is offered, it's often at the expense of appreciation growth. So many times you'll have to choose either equity participation, which is the 80-20 split, or the pref. But because we are confident in our business plan on Canberra, we are offering both. So you would get your pref, and then if there's any additional monies to be distributed, they would be split 80% to the limited partners and 20% to the GP or deal sponsors. Okay, we have another question here. What will trigger a refi? Okay, the successful stabilization of the property. The moment we have the opportunity to pull substantial amounts of equity and return it to the investors, we will. And as stated, we expect to do that in either year 2 or 3. Okay. Next question is, when can I expect distributions? Again, this is a major value add, and we will need at least 12 to 18 months to stabilize the property. And we expect to be investing a very large amount of capital into the property the very first year. And that's in addition to the very aggressive retenant plan. So we do not anticipate a payout in year 1. Okay, we have, so explain catch-up. Okay, so catch-up is the process by which we make preferred returns whole. So you are due a preferred return every year, but as we had stated, we don't anticipate being able to pay one in the first year. So you will have a balance that carries forward, and that will be paid out as cash flows continue to rise. So for example, in year 2, if there's profits left over after we pay year 2's pref, we would continue to pay the catch-ups from year 1. Okay, how can I prove accredited investor status? There's several ways, but the key is to start early because none of them are fast, and you have a really short window to make your investment. So there are secured web apps that most institutional platforms use, the largest of which is Verify Investor, and we will engage them on this deal. But also you can get a certified letter, a certification letter from professional staff, and most often that's your CPA, but also can be an attorney or a certified wealth advisor. There are so many people on the team. What are the roles and responsibilities? Well, briefly, Brian and Nicole are the asset managers. They are our boots on the ground. They live in Phoenix. In fact, Brian lives only minutes from the property in the famous Biltmore area. And Chris is our operations guru, and he's the numbers guy. And I handle investor relations and the capital stack, and I'm also the talking head of the bunch. Okay, this is a good one. I haven't used DocuSign before. What is it, and can I trust it? Well, DocuSign is the industry standard for electronic signatures and is used not only by most banks, but also by the legal profession and most of the large real estate transactions that I'm aware of. Ooh, here's a toughie. Please explain more about accelerated depreciation and bonus depreciation. Well, this can get really deep in the woods, and I will say it's a subject that's best discussed with a competent CPA that is used to handling large real estate transactions. But having said that, there are numerous videos and webinars that have tackled this in much greater detail than we can go into here. But briefly, cost segregation is a tax strategy that allows you to accelerate depreciation. And of course, depreciation is that magic bullet that allows us to get a lot more money back on our tax return. And bonus depreciation does this much faster than the normal 27.5 years. And it allows you to keep much more of your money instead of loaning it to the IRS for 27 years. Okay. All right, it looks like that's all of the questions, but if you think of any more, please email us at canberraphx@gmail.com, and we'll gladly get you an answer as quickly as possible. So we want to thank you very much for taking time out of your busy schedules and hope to see many of you as our partners in Canberra. Happy investing and good night.